Welcome to The Truth About Taxes and Retirement. This podcast is brought to you by SavingYouTaxes.com and hosted by J. Barry Watts. As an advanced tax strategist and enrolled agent federally licensed by the IRS, Barry is uniquely qualified to go deeper into the Internal Revenue Code than most accountants. He understands and interprets its provisions, explaining how they'll help you reduce income taxes you owe so you can direct that previously wasted tax money into tax-free accounts that you can enjoy in your retirement years. Now, on today's episode.
You ever think about the taxes you'll pay in retirement? Will they be less or more than you pay today? Are you guessing? Or do you have the data to back up your answer? Our resident tax expert, J. Barry Watts from the WealthCare Corporation, knows that for nearly all of us, taxes will be higher in retirement than they are today. Even more, the average retiree will pay thousands of dollars in additional taxes to the government that are hidden from view. Sometimes you never even know you paid them, but they reduce your wealth, weaken you financially, cause you to run out of money earlier, and diminish the financial legacy you leave to your heirs. Today we talk about the hidden taxes in retirement with host J. Barry Watts on this edition of The Truth About Taxes and Retirement.
Hello and welcome to another edition of The Truth About Taxes and Retirement. Thank you, Patrice. You're absolutely right when you say you're going to pay more taxes in retirement than you do now, probably more than you've ever thought of. And to add insult to injury, you're going to not only pay more tax outright, but additional hidden taxes that most likely you've never considered. I'm J. Barry Watts, a tax strategist authorized to practice before the Internal Revenue Service of the United States government, and a retirement designer who for 30 years has been helping people dismount the workhorse and step into the cool stream of retirement in the most tax-efficient, lowest volatility way so they can retire with confidence, age with dignity, and create generational legacy. Now, today's edition of the broadcast is brought to you by the WealthCare Corporation, and it highlights hidden taxes in retirement. There are many. They are costly, but they're mostly obscured, and I've discovered from tens of thousands of hours sitting across the conference table from people who are preparing to retire that most folks simply have no idea they'll have to pay these taxes. Now, interestingly, these taxes are, in most cases, entirely, totally avoidable with strategic tax planning. So today, I'm going to unpack some of those taxes, explain them, and share with you an anecdotal story of someone we were able to help save significantly on their income tax. How does that sound to you, Patrice?
Outstanding. My ears are open.
All right. Well, let's get into a conversation about the first one. The first hidden tax is the tax that you pay on Social Security. Oh my goodness, I haven't been asked about this tax for 15 whole minutes because a client who I talked to just before we came into the broadcast booth called me and was discussing, she's only 59 years old, so she can't draw Social Security yet, but she had sold her business and she's talking about now she's got all this money, and she said, now all this is going to cause my Social Security to be taxed, isn't it? And I'm like, yes, it is. And by the way, do you know what she does for a living? She is a certified public accountant.
Oh, so she knows taxes.
Well, she knows tax preparation, but no, she really doesn't know tax strategy. And so she's asking me, and I'm not a CPA, I'm an enrolled agent. I can do the same work before the IRS that a CPA can do, but I'm not an accounting guy. So she's asking me about how her Social Security will be taxed. And here's simply how it works. To determine whether or not your Social Security will be taxed, the IRS has a formula. And they take all of your income and they add it up, including your Social Security income. So Social Security itself counts against you in determining whether or not your Social Security will be taxed. And they add to that your tax-free municipal bond income. So see where this is going.
Tax-free, wait.
Your tax-free municipal bond income counts against you for figuring out whether or not your Social Security will be taxable. And if the total number that when they add up all your income, if the total number exceeds 34,000 for a single person or 44,000 for a married couple, then your Social Security will be taxed. 80 up to 85% is the maximum amount of your Social Security that can be taxed.
That's
And
not a
so,
lot of money there, Barry.
well, no, it's less than it was just a short time ago, based on what inflation is doing today. So if you've done any saving in your life, if you have any assets that generate income, if you inherited any money, well, then it's not very hard for you to exceed that 34 single, 44,000 married kind of number. So let's go through a little example. Let's say you and your spouse are both making $2,000 per month in Social Security. And by the way, most people are making more than that. But let's say you're making $2,000 a month, each of you. So that's $48,000 per year in the family for the husband and the wife. Now, half of that 48,000 counts in determining whether Social Security is taxable. So the magic number there is $24,000. That's only 20,000 short of that magical 44,000 number where Social Security is 85% taxable. So now let's say, in addition to that $24,000 number, let's say you've got $1 million in IRAs. Well, the first year of required minimum distribution out of those IRAs is going to be about $34,000. So now your income counting against Social Security is $58,000. Add a little pension to it, say $1,000 a month, and we're at $68,000. So let's just stop right there. You're at $68,000 now. And you get to take the standard deduction, which for a married couple, if you're married, is $25,900 off of that $68,000, which brings us back to $42,100. So you're only $1,900 away from your Social Security being totally taxable. Now, if you've got a brokerage account, if you own some stocks that generate some dividends, if you have some money in any kinds of fixed income investments that are paying you interest, if you own a rent house, if you have a farm like I do and you sell a few cows, if you are like one of my retirement clients, she's a hostess for the St. Louis Cardinals. She's responsible for making sure that everyone's experience when they come to the stadium is just wonderful. And she gets paid a bit for that, but she just loves being in the game and at the stadium and with the people. If you own a few bonds, even tax-free municipal bonds, all these things feeding in and working against you, and they will cause you to unexpectedly pay tax on Social Security. And most people have no idea that this is going to happen. And if they do have an idea that it's going to happen, they don't have any idea what they can do about this.
But this is all stuff that we think we're supposed to be doing. We're building a nest egg for retirement.
Well, you are supposed to build a nest egg, but you need to build it soundly and solidly in a way that protects you from these kind of problems. And that is doable. But you need someone who knows how to build a protected nest egg. And of course, that's what we do every day for the clients that we work for. So the point is, if you're just meandering down the road, reading Money Magazine, the Wall Street Journal, and just doing the things that the culture and the community and the employer have taught you to do, putting money in your 401k and storing it away for a rainy day, you're probably in the target for this hidden tax to hit your Social Security. But it doesn't have to happen that way. So, Patrice, let me suggest to you something I want you to picture in your mind. Okay, since if we were in the room together, I would go to the whiteboard on the wall and I would draw pictures, and they would be not very good drawings that wouldn't win me any art awards, but you'd be able to grasp this. So, since I can't draw it, you're just going to have to imagine it in your mind. Now, sitting in front of you on the table, there are 3 containers. The first one over on the left-hand side is labeled taxable, and anything in it that generates a W-2 or a 1099 form for you, it goes into the taxable container on the table.
Mm-hmm.
Now, the second container, the one that's going to be in the middle of the table, is labeled tax deferred. And in it are your traditional IRAs and 401ks or 403bs or 457 plans if you work for government. And over on the right-hand side is the third container, and that's the container that's labeled tax-free. This is the container that holds your Roth 401k, your Roth conversion, your Roth IRA, your health savings account is in this third container. And your LIRP plan, your tax-free life insurance retirement plan, goes into that third container. So you see the three containers there in your mind, Patrice?
Absolutely.
All right, three containers. Left
Yes,
is
yes.
taxable, middle tax deferred,
Yes,
right
yes.
is tax-free.
Yes,
So
yes.
here's how you avoid this tax on your Social Security. You protect yourself from the hidden tax by maximizing the amount of money that is in container number 3 on the right, the tax-free container.
But how?
Well, you have to strategically integrate a Roth into your plan and move money from the middle container to the container on the right. You have to set up an HSA, a health savings account, if you qualify for it. If you've got money sitting in that first container over on your left, the taxable container, you have to figure out how to get that down to the tax-free container, and you use a tax-free LIRP plan to get that done. So this is how you begin moving money from the left to the right. And in a perfect world, we'd wind up with all the money down at the right, so we don't have to pay any taxes on any of that money. And there's no negative impact on our Social Security, so the hidden tax goes away. It's not that hard to do. But if you don't do it every day, I could see where it would wrinkle up your mind and cause you to just put it all away and go do something that's a lot more fun.
Yeah.
So what people do is they come and they sit down with us and they spill all their stuff onto the table, and we sort it. We sort it into these buckets, and then we go see how much income there is and what the tax bracket is going to be and what the tax bracket's going to be in the future and how much headroom they have to move money without jumping a tax bracket, and what happens if they do jump a tax bracket. Because there are some tax brackets that you can jump and it only costs you 2% more in taxes, not very much. And there are other tax brackets that you can jump that will cost you as much as 12% in taxes. So you have to know this stuff, and you have to know how to integrate it together. And you need to work with a professional who does that. Now, here's the deal. Most likely, whoever does your tax return is not that person. Because people will say to me, yeah, we've got a tax person. Well, no, you have a tax preparer probably. And your tax preparer probably doesn't know anything about the kinds of things that I'm talking about. Their specialty is taking the numbers at the end of the year and being sure they're reported to the IRS accurately, which is very important. Our specialty is making the numbers turn into different numbers so that when you report them to the IRS, they report as tax-free numbers, and you don't wind up having to pay hidden taxes on your Social Security. So it's time to look at the second hidden tax. And this is a tax that has a lady's name. This tax is called IRMA. IRMA.
Dear Irma.
You don't run into very many little girls these days named Irma.
There's a reason.
Well, now, wait a minute. I'm quite sure that some of my favorite listeners to the broadcast probably are named Irma.
That might be their middle name.
So take it easy, Patrice. Is that your middle name? Is it Patrice Irma?
No, it is not.
Oh, okay. Just checking to see. Okay. If you don't plan ahead to deal with the second hidden tax, which is called IRMA, that is spelled IRMAA, then you will wind up paying the IRMA tax all of your retirement years. Now, IRMA stands for Income-Related Monthly Adjustment Amount. You can't make this stuff up. I mean, that just sounds so much like something somebody from the government would come up with. It just offends me. Now, here's what IRMA is. IRMA is the amount that you're charged for Medicare once you reach age 65. And based on how much money you make, well, then you may have to pay more for your Medicare. That's what IRMA is. Most people don't even know that they have to pay for Medicare. They think when you get to be 65, it's free because they paid for it all these years. No. At 65, then you start paying a monthly Medicare premium that can be withheld from your Social Security check. And it is a minimum of $170 per month. So it starts at $170 per month for anybody who's making less than $91,000 a year. But if you make $114,000 a year, then it goes to $248 a month. And so it grows so that your IRMA can be a maximum of $578 per month per person that you pay to have Medicare. So think about it. 578 times 2 is what? $1,156 a month, I think, if I did the fast math. My math teacher would be proud of me, but he died last week. So, and he probably wouldn't have been proud of me anyway. But he really did die. I saw the obituary on that. He was the math teacher and was the the drug dealer in my school, actually.
Drug dealer.
Yeah. Just that was just the way it worked.
Wow.
And his grade book was always up at the front of the class. And if you didn't like the numbers that were in it for you, you could just go up and erase them and put in your own numbers.
What?
Ask me how I know. So that was the way math worked. That was the way math worked in the 1970s in the little high school that I grew up with.
That's that new math. That's that new math. I guess.
It was new math. That's exactly right. I don't like your old math. Let's get me some new math in there. So it's funny that I'm in a business that's so math dependent. We're talking about IRMAA. There wasn't any IRMAA in my class then. So IRMAA is the amount of tax you pay on your Social Security, the amount extra you pay. I'm sorry, not Social Security, the amount of tax extra that you pay to get Medicare. And it can cost as much as $578 per month per person. So if you've got a good income in retirement, like you want and like we want you to have, then you could wind up paying over $400 more per month, from $170 to $578. Over $400 more per month for Medicare because of IRMAA. Yet practically nobody knows about this.
That's a lot of money.
That turns into a lot of money. I mean, if $400 a month over 12 months is what? $4,800 a year times a husband and a wife. So the question is, well, how can we avoid paying the hidden IRMAA tax? Let's go back to your table, Patrice. Do you see those three containers? There they are.
Got it.
Taxable on the left, tax deferred in the middle, tax free on the right. You have to strategically integrate container number 3, the tax free container, into your retirement plan by moving money from container 1, the taxable container, and from container 2, the tax deferred container, into container number 3, tax free. But you have to be strategic when you do it, or else you'll wind up paying too much tax all at once. There's a right amount to move each year based on your specific situation. And you've got to work with a tax advisor to help you figure this out in most cases. And if they can't,
you got to do this every year.
Yeah, you have to. Well, for a few years. Once you get it all done, then you don't have to do it. And on our next broadcast, we're going to talk about some people we've done it all for and how that all fits together.
Nice.
But so for a period of 3 or 4 or 5 years, maybe, you have to do this every year, and then you cross a line, the magical line of the 0% tax bracket, and then you never have to do it again. And guess what? IRMAA stays at $170.
Where she should be.
Yeah, keep IRMAA. And by the way, your Social Security taxability goes back to 0. No tax on Social Security because you went through this process. Now, I need to talk to you about tax advisors a minute, and this is really important. Because I deal with some high-level people who don't get it. And they will, in conversation, they'll tell me that they have an expert tax advisor, and they don't. They've got a preparer, not an advisor. They sure don't have a strategist. And the reason I know is these smart people, consultants making 7 figures a year from their work, in some cases running really significant multi-million-dollar corporations, they'll hear me speak somewhere and they'll sit and nod their head in agreement with everything I talk about. And then they'll stumble up to me after the meeting and they'll tell me, oh, I've got a tax advisor. And I ask them this simple question: how often does your advisor present you a tax strategy to save you money? And they'll look at me dumbfounded and they'll say, he doesn't. He just fills out my tax return. That's right. They have a tax preparer, not a tax strategist. So if you find yourself in that position and you want help, call me. Just go to savingyouTaxes.com, savingyouTaxes.com. And there you'll find a phone number where you can dial us up, schedule a time for you and me to talk. And we'll get you on the path to helping you avoid IRMAA, maybe altogether, depending on your age. Maybe we'll just shorten the number of years that you have to pay IRMAA. But most people can dramatically shorten the length of time they pay IRMAA by 20 years or more. So think about it for a moment. If it's $800 a month because of a husband and wife, it's $9,600 per year for 20 or 25 years. That's roughly $200,000 in tax that you won't have to pay if you will plan ahead.
Think of the cruise you could take.
You could take a good cruise on $200,000. You certainly could. But you've got to start planning and you've got to commit to this. And Patrice, it just occurs to me that both of these taxes we've talked about, the hidden tax on Social Security and the hidden tax called IRMAA, they fall into a category that we've discussed recently called the dumb tax. Because there are things we don't know and we don't bother to learn and we don't know where to get the information or how to learn it. So we become victims, and over we pay the dumb tax. And I just want to say to you, if you're paying the dumb tax, stop it. Stop it. Stop paying the dumb tax. You just have to learn a few things and then do them. And I am astonished. I had a guy in just a month or so ago who's paying over $300,000 a year in taxes.
Holy cow.
I showed him right out of the gate how he could save over $200,000 of that $300,000.
And
he stumbled away unconvinced.
let me think. He probably said it's too good to be true.
Well, maybe. I don't know. He didn't even finish the conversation. He just kind of wandered away. Because people do that. I don't know. Maybe they're stunned at the news and they just can't accept the good news is perhaps the problem. But my point is, these problems are curable if you'll just find a person who knows how to deal with it. And there are more than one of me. I've got colleagues around the country who do know how to do this, but we work with clients literally from the Pacific to Atlantic coast and literally from the Canadian border to somewhere deep in the Caribbean. That we help to accomplish these particular things. So you can call us if you don't have somebody, and I hope you do. If you don't have somebody, call us. Just go to savingyoutaxes.com, and there you'll find a phone number. You can reach out to me. We'll schedule a time to talk about these hidden taxes and how to avoid them. Now, Patrice, let's bring this in for a landing by talking about the third hidden tax, a tax on your charitable contributions.
Wait. No. You make a charitable contribution that's deductible.
Well, you're absolutely right. It is deductible, but you may still be paying a tax on what you contribute to the charity before you get the deduction. This is right out of my practice last week. I had a husband and wife in. They're contributing $12,000 a year, $1,000 per month to the church that they attend.
Mm-hmm.
And you know where they're getting the money? They're getting it from their IRA. They're taking $1,000 a month out of their IRA. Now, in order to get $1,000 out of their IRA to give to their church, that 1,000 is a net number. They have to pay taxes of 24% because that's their bracket, plus 6% state tax. So they have to pay 30% in taxes. So instead of $1,000 a month, they have to take $1,300 per month out of the IRA, pay the tax, and then they'll have $1,000 left. But oh, guess what? The additional $300 per month in taxes is in itself taxed. So that $300 they have to pay a tax on, it winds up being about another $100. So they actually have to withdraw approximately $1,400 per month in order to contribute $1,000 a month in after tax to their church. Now, here's the deal. They are throwing away $400 every month, $4,800 per year in unnecessary taxes because they are handling the contributions incorrectly. These people qualify because they're old enough to make what is called a qualified charitable distribution directly from their IRA account. And anybody can do this. You can contribute up to $100,000 per year directly from your IRA to charity without paying any taxes on that money. And it even gets better than that. Approximately 1/3 of the money that they can give away is money that would have actually gone to Uncle Sam in taxes. So giving $1,000 really only costs them about $700 real dollars from their account, if that makes sense.
Help me.
Well, think about it. You give $1,000 away, and that money's been building up in your account all this time. About 1/3 of what's in your account really belongs to Uncle Sam. So when you give $1,000 away, about 2/3 of those dollars are yours, and about 1/3 of those dollars belong to Uncle Sam. So we're getting a discount on the money we're giving away. We're giving away a dollar bill that only costs us about 70 cents when we give it from the IRA account. So in that particular case, instead of withdrawing $1,400 out of their account, by just giving $1,000 directly, and that $1,000 directly really only costs them about $700 because the rest of that was tax money that was built up in their account. We just took the total cost for them from $1,400 down to $700. We saved them about 50%, all because we handled the taxes differently. Now, the question would be, these are smart people. Why didn't they do this before? And the answer is because they didn't know. They were paying the dumb tax. The hidden tax on charitable contributions was costing them over $8,000 in real spendable money each year. And the day after our meeting where we eliminated that tax for them and showed them what they could do, they called us back. I didn't get to speak with them. I was in a meeting, but they talked to one of my team members, and they were just excited to celebrate this newfound tax savings that had happened to them because they sat down with us and we'd showed them a hidden way, unknown to them, that they could save these taxes. So here's the deal, Patrice. You and our listeners can keep paying the dumb tax. And most people who listen to this podcast will, but a smart few will call us by going to savingyouTaxes.com, where they'll find a phone number, and we'll have a discovery conversation to uncover ways that they might set themselves up to pay hidden taxes. And we'll discuss how they can eliminate those taxes so they'll have more money in retirement. They can retire more confidently and maybe even create a generational legacy for those that they love. Until next time on The Truth About Taxes and Retirement, sponsored by the WealthCare Corporation, I'm Barry Watts, reminding you that if you don't get the taxes right, nothing else matters.
Thank you for listening to The Truth About Taxes and Retirement podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of SavingYouTaxes.com. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional tax and investment advice. Always seek the advice of your own qualified advisor with any questions you may have regarding taxes and investing.
This podcast is a production of the WealthCare Corporation, found on the web at SavingYouTaxes.com. The concepts discussed are for informational and educational purposes only and should not be implemented without first consulting with your own legal, tax, and investment counsel. This has not been an offer to buy, sell, or invest in securities, and this information is to be taken as educational concepts, not as advice for you specifically. The lawyers like us to remind you that all investment involves risk, and you could lose money. Past performance is never a guarantee of future results. Tax strategy services are provided by American Tax Strategies, LLC. Investment advisory services are provided by WealthCare Asset Management, LLC.